Thank you, everyone, for tuning in to today's webcast. It's Brickell Analytics. Isaac Gilinski, founder and head of research for Brickell Analytics, is back with us, continuing on a long tradition that started over 10 years ago, where he shares his technical research with our members, our group. Isaac has been a purist when it comes to technical analysis. So, for those of you that don't know him, he uses wave theory, sentiment analysis, velocity indicators on major equities, fixed incomes, rates. Um, uh, so he's looking at the major indices out there, the major asset classes. So it's macroeconomic research, but it's using pure technicals. He likes to ignore fundamental analysis and really focus on technical analysis. And for those of you that do know Isaac, he stays true to that, and he focuses only on technicals. He doesn't want to know the story on fundamentals. So I would like to welcome a long-term guest for our group, Isaac Gilinski, a member of FLIA. And as always, I want to thank you for your time and attention. And I hope that you get the maximum out of today's presentation. As we go into the holidays, you're able to reflect on what's happened in the previous year and prepare for what's coming in 2023, which is definitely going to be, once in a lifetime events for financial markets. So, Isaac, if you don't mind just going through your presentation, and then we'll start the questions in a little bit. So, audience, there's a chat function on your desktop. You can put your questions into the chat, and we'll go back and forth with that. So, Isaac, I'm going to turn it over to you, and I'm going to drop out of the picture here.
Mike, thank you for the introduction. I'm going to assume that most of the participants know who I am and have sat through the original introductions of our research. So I'm just going to skip through everything that has to do with my background. If you need it, we'll talk about it later and go straight to the forecasting. So we did not do many events in 2022. We were here in 2021. And because our forecast in 2021 kind of like panned out, there was very little need to come here and just pretty much say the same thing. So what we said in 2021 was that the S&P was going to go into a bear market, that it was topping, that the top was going to be, above 4,400. It was, and when it got close to 4,800, we were forecasting a big drop. So we had a big drop. We had a drop from 4,800 in the S&P to 3,500. And the drop in 2022 has been very interesting from a technical standpoint, because based on our forecast, if you look at the charts and at the top, at the end of 2021 or beginning of 2022, we saw in technical terms what was an ending diagonal pattern. And the ending diagonal pattern was kind of giving us with certainty two things. Number one, that the S&P was going to drop. And number two, that the S&P was going to drop to about 2,200. So we got the first part right. We got the forecast part right, and the direction of the markets right. The S&P dropped. It dropped 27% instead of dropping a little bit more than 50%. So when we got half of the drop right, we've spent all of 2022 thinking about the stock market and whether it makes sense to continue and push for further declines based on this ending diagonal pattern, or whether we should evaluate it and reverse our forecast, because maybe that 50% decline that was supposed to take place will not happen right now at this specific stage in the cycle. I mean, in these cycles, you can be right on your price or your direction, but you can be very wrong on your timing. So the timing is a very is perhaps the most important ingredient in the business of forecasting. And it made sense to evaluate the timing based on what has been happening in 2022. So what has been happening in 2022, we're going to summarize it in a very short quote. It's called death by 1,000 cuts. So we've had a market that has gone down 27%, between early January and mid-October, very, very slowly, very gradually, 2%, 1%, 50 basis points, 3%. It has been a very tiresome decline in terms of percent drop on a daily basis, number one. And number two, we've had no fear, we've had no panic, we haven't seen the VIX surge to 50, 60, 70, 80. VIX has stayed very tame. In fact, the high in the VIX was reached during the first drop in January, which was about 38. Then all the subsequent declines in 2022 were accompanied by lower VIX levels. So VIX reaching what's called in technical terms lower highs. And the market kept dropping and dropping until we got to about 3,500 mid-October. And, the decline kind of ran out of steam. What's very, very interesting from a sentiment standpoint, for those of you that believe in sentiment, is that even though the market dropped, and the drop was not accompanied by a panic, there was no crash, there was no systemic banking failure, nothing really happened. The market sentiment turned decisively bearish, like decisively bearish. And what I mean about a decisively bearish number is that we saw numbers that we haven't seen in 20, 30 years as it pertains to sentiment. Everybody was negative. And so people flipped to the negative side, people flipped to the bearish side, sentiment began to hit record extremes. And another interesting thing that we saw was crash forecasts from mom and pop to Bloomberg to big hedge fund managers, everybody calling for a crash. And we have a 22-year history of working in finance, or our background. We've been working in finance for 22 years, and we've been forecasting crashes for a majority part of our career, which I would say maybe is about 15 years. And then, or crashes or declines or pullbacks, and pullbacks, declines, crashes, corrections, nobody sees them coming. Nobody can anticipate them. They're surprise events. And it did not become a surprise event in 2022 as the market went down. And it made us reevaluate and be like, okay, maybe this is not that crash wave we were forecasting in 2021, but instead it was some sort of large correction. So in the magnitudes of, instead of saying it's a 10% correction, it was a 25% correction, 24% correction, 27% correction in the S&P, much larger correction in other markets. And in wave terms, that's called a wave 4. Wave 4 down. Corrections are either wave 2s or wave 4s. We're at the ending part of the bullish cycle that started in 2009. So this is not a wave 2 down, it's a wave 4, and maybe it's a wave 4. And if it's a wave 4 down, there's one big rule, cardinal rule. If it's a wave 4 down and we have to go up in a wave 5, then wave 5 up always exceeds the starting point of wave 4 down. So the starting point of wave 4 down is that January high in the S&P, which is 48.18. So we're going to now forecast a wave 5 up, which means the S&P has to get to about 48.20. And then anything above 48.20 is, a bonus. So the S&P could top at 48.20. It could top at 5,000. It could top at 6,000. We came up with the 6,000 level using a little bit of Fibonacci analysis. Fibonacci is a form of technical analysis that allows you to project what's called extensions and retracement price targets. So we're going to say that, the S&P bottomed in March of 2009 and started a very large bull market that's for now taken about 15 years. That bull market was 76% complete at the end of last year, at the beginning of this year. And because it was 76% complete, it needs to be 100% complete, and needs to rally to about 6,000. But then again, this is forecasting, this is projection. It may be right or it may not be right. Other equity markets were following, so emerging markets look bullish. We've had some sort of large corrective pattern between 2008 and 2015. We had a decline, and emerging markets should rally, on the EEM about 50%. Interesting what's happening, the dynamic between Europe and the US. So if you look at the UK FTSE, the UK FTSE has literally erased its losses for 2022, yet the S&P hasn't. So based on where the UK FTSE is, the S&P should be at 4,800. It should erase the 2022 losses. And we've never really seen a situation where Europe recovers its losses and the US does not. And what's interesting is that Europe, from an economic standpoint, is in worse shape than in the US, yet Europe has recovered its losses, the US has not. So, based on where the S&P, where the FTSE is right now, the S&P should be at 4,800. The German DAX is even more correlated than the S&P. German DAX is trading at about 4,300 on the S&P. So we're lagging by about 500 points. So, the US should catch up. We did a presentation, a live flyer presentation before COVID started. I think it was at the Greenberg Torque building at the end of 2018, during that decline in 2018. And what we did is we discussed a spread between China's Shanghai Composite and the S&P. And that spread ended up working out really well, because what we said back in 2018 was, and you can see it here on this chart, Chinese equities are trading at a discount relative to U.S. equities, and you just take the Shanghai Composite, you subtract it by the S&P, and if you get a negative number, that means equities have to rally because China's is very inexpensive relative to the U.S. China's the higher growth country, so China should typically outperform the U.S., or at least that's what we have seen over the last 15 years. So you can see by this chart, where we draw a circle here, when China is positive, 2007, it was a clear indicator that markets were topping. Then again, in 2015, we had a correction in the U.S., we had a sovereign debt crisis in Europe, and then China crashed. And then the 2015 crash in China, just Chinese markets kept dropping all the way down to 2018. Then U.S. caught up to China and dropped in 2018, but still, the U.S. had gone up so much that the U.S., the Shanghai Composite S&P spread was negative, which was giving us an indication that, markets had to rally. So markets rallied between late 2018 to early 2020. Then we had a COVID crash. Then we had the rally that followed COVID, and then we had another large decline. And now the Shanghai Composite S&P spread is at the most negative level since you can track this sort of relatively new indicator, if you want to call an indicator that has a 20-year lifespan new. So Chinese equities are very, very cheap relative to U.S. equities. We can attribute a downtrend in the spread, meaning the U.S. is a more attractive investment landscape relative to China. So we don't think Chinese the spread between the Shanghai Composite and the S&P is going to go back up to 4,000, which is where it was up in 2007, or even 2,000, where it was out in 2015. But if the spread goes up by 500, 1,000 points, we're talking about 100% rally in Chinese equities and about a 50% rally in U.S. equities, just to get the spread to 500, 1,000 points, which is a declining trend channel according to this line and in this chart. Now zeroing in on U.S. equities. So U.S. equities, we've seen a lot of rotation out of technology shares into old economy stocks that pay dividends. That's why the Dow Jones has been outperforming the S&P. And we've heard a lot of talk about those COVID stocks that had this COVID bump and rallied a lot because the economy was closed and people were working from home. One of those stocks that are considered COVID stocks is DocuSign. DocuSign surged between 2019 or say 2018 and 2020 20 and 2021, the 2021 high, it went from like 50, 60 all the way up to 300, and then DocuSign crashed. It went from 300 to $40. It was like an 86% decline. Now, we do not think DocuSign is a COVID stock. Maybe it benefited from the COVID bump and now has been punished, but DocuSign is a first mover, and DocuSign is the type of company that's in here to change how we do business. There's a paper we wrote on DocuSign that I think has been emailed out by Flya. There's a second part we're in the process of putting together, which actually ironically includes a little bit of fundamental analysis. So we don't want to go into too much detail, but we think DocuSign is here to change the way business is done. And in a nutshell, it's going to replace the pen, the paper, the printer, and people are just going to sign contracts, using DocuSign. Now, if we don't head into recession, which we think we won't, if the market doesn't crash, which we don't think we won't, then DocuSign should at least recover some of its losses from the decline over the last year and a half. So we're going to, not call for a new higher high in DocuSign, but if it rallies, 3-4 times from here, it recovers 50% of the losses. We're talking about a $180 to $200 stock price. We're going to do some fundamental analysis on that and send it out as a second part to the paper that was circulated by Flya. But that's a nice trade. 3-4x, up to 180, 200 should be, a nice trade. Another company that is very low relative to where it should be, and again, people are going to use PayPal whether the economy is open or the economy is closed. This is really not a COVID stock. This is a new way of transacting, and PayPal has been very, very oversold. It makes money, interestingly enough. Net income, again, using a little bit of fundamental analysis, net income on PayPal is the same as net income on Salesforce. Yes, it's about 40% discount to Salesforce. So, PayPal's a $69 stock. We don't think it's going to go up to 400 or 350, but if it goes up to 200, that's a 3x trade. And again, if the economy doesn't shut down, if the market doesn't crash, if we don't go into a recession, some of these tech stocks that have been heavily punished because of the so-called, reopening trade should, participate in a very significant bounce. From what's going to contribute to the rally is our forecast on government bond yields. We think the 10-year yield topped in October at 430 basis points. Yields will now go down, and yields going down will be bullish for foreign currencies, emerging markets, bearish for the dollar. That should be initially very positive for equity markets. We saw this in 2018. In 2018, the Fed was raising rates. Equity markets were going down. 10-year yields peaked. Equities bottomed. And then yields started to go down. And 2019 was Goldilocks. It was a beautiful year for equities. Beautiful year for equities. Equities just rallied. And then equities crashed in 2020 while yields continued to go down. So we're at a point where yields are going to go down. That's going to be bullish for equities until, yields going down too much is bearish for equities. Or what could happen is either yields go down too much or yields then reverse higher and spike, losing control depending on, the pattern right here. We think the 10-year yield will go down to 2%, whether the 10-year yield goes down to 0 or spikes up to 6%. It's just a matter of what we see at that point. But regardless, we're going to have, a permanent inflation go to temporary inflation, go to disinflation. Disinflation is good for the Goldilocks scenario. And then we'll have a deflationary busts. The deflationary busts usually are accompanied by a declining yield, but you could also have what's called a rising yield deflationary bust, where yields go down sharply and then up sharply. And then we'll be ready to make a longer term forecast in yields after we've seen, about a 200 basis point decline on the 10-year yield. For now, our forecast for the next 6 months to 12 months is 10-year yields drop to 2%. And that's good for equities. And that's especially good for equities that are, high growth, low dividend stocks such as DocuSign and such as PayPal. The US dollar is very high, very overbought. It should go down. a decline in the Dixie down to 90 is going to be bullish for equities. And then, one favorite topic here, Bitcoin. As many as you know, we dislike that asset class. We think it's a highly overvalued asset class. We were very, very bearish Bitcoin at 68,000, and throughout 2021 calling for a collapse. We called for a 95% drop in Bitcoin from 68,000 to about 3,000. Now Bitcoin dropped from 68,000 to 15,000. It didn't quite get to our 3,000 target, but it's the same forecast we have to make in Bitcoin that we're making on the S&P. If we're flipping bullish on the S&P at 3,500 and not forecasting a collapse right now to 2,200, we have to forecast a rally in Bitcoin. And so we think Bitcoin, it's either going to go up to the all-time highs, which is 70,000, or at least rally to 40,000, 45,000. It's going to rally about 100%, 200%, 300%, 400% from here. And it just has to go up because it's gone down a lot. Everybody's negative, and we're turning bullish on the S&P. So it makes no sense to press our 3,000 target on Bitcoin right now. We'll get back to that at a later date. And we get asked a lot about our opinion on Coinbase. Look, if Bitcoin rallies, Coinbase is going to rally. This chart shows a 30 price target on Coinbase, but Coinbase could have bottomed this week at 34. There's a nice 5-wave decline since the company IPO'd. You can see that in the charts, 1, 2, 3, 4, 5. And but Coinbase should stage a counter trend bounce. Again, this is counter trend. We're not calling for 1,000 on Coinbase or 500, but a nice counter trend bounce on Coinbase from current levels, so that Coinbase recuperates, half of its losses, will bring this stock up to 150. So we're talking about 5 times your money. It's a nice trade. Same thing as DocuSign and as PayPal. And that's it. That concludes our presentation. And now I'd like to open it up to questions.
So, Isaac, can you hear me?
Yeah, I can hear you now.
All right, great. So let's start off by going into Brickell Analytics and your systematic forecasting method. Just briefly recap for us the 3 components that you use in your reports.
Yeah, so there's actually 4 components, but one of them has nothing to do. It's a separate component. So our report has 3 components. It has sentiment indicators. It has price analysis, so sentiment is sentiment. Price is a combination of Elliott wave and Fibonacci analysis, and then it has velocity. So those are the 3 components of our technical research service that work together. They're intertwined. They're kind of part of the same relationship. And then the separate component is time, our time model, which we use for our global macro analysis. The time component does not go into our quantitative systems, as you guys can see in this chart here. A report divides into 2. It's a discretionary report and it's a systematic report. And the discretionary report is divided into 2 types of analysis, which is velocity, price, and sentiment, and then the time component. And the systematic report is just price and sentiment, because it's just a signal on the S&P and on oil.
So, Isaac, what is the what is the expectation as a client of Brickell Analytics? What types of reports do I get on a daily basis? Which types of reports do I get on a weekly basis?
So on this slide, our systematic research, which is our quantitative model with some indicators, that goes out daily. So you get 1 report a day, which is a systematic report. And then you get 1 weekly report, which is a discretionary report, which I write, that's complemented by charts from our research team. So our research team, we have a director of price analysis that does our charts, our waves, our forecasts, and then we have a director that programs our quant models. So this report that goes out on the weekends, I'm the editor of the report. I write it, but the charts come from our macro, chart analyst technician, and so you can ballpark 50 trading days a year. You get 250 daily technical reports, and you get about 50 macro commentaries. So I would say about a total of 300 reports.
So Isaac, with regards to the weekly report that you publish, um, can you give us a like a flavor for um, what types of charts, what types of projections come out on a weekly basis, and how to integrate that into managing my portfolio? How do I use your research best?
So we come up with these forecasts. However, this is more longer term. So right now we set up, let's say we set up a 6,000 target on the S&P, but our weekly report zeroes in more. So let's say we're at, I don't know, 3,800 on the S&P. We're going to say, hey, the S&P is bottoming here, 3,800. It's going to rally to 42. At 42, we may say, it's going to chop or consolidate for 2 weeks before it goes up to 44. But we put up these charts on the report, and I write about it, and whatever the theme is, we talk about it, and we do charts on the global macro spectrum, which is equities, commodities, fixed income, and currencies, which I guess you can include Bitcoin in it as well. And that's what it is. It's just charts with price targets, and they're more shorter time in nature, so they're more directional, give you more idea, more on a market timing standpoint if you're trading more short dated. If you're passive, you're a passive manager, I guess the reports, you don't have to read them that often. You just want to know what's going to happen bigger picture over the next 6 months to a year. If you're a trader, you want to trade every week, these reports become more relevant.
So I've had a decade plus to digest your systematic process and really get to know you and see how you stick to things. What number are you at with regards to your report? I know you keep a sequence.
Yeah, we publish what's issues. We're gonna next year we'll reach 5,000 issues.
5,000 issues.
5,000 issues. Yes, we're at like 4,950, something like that. We have 50 more issues before we get to our 5,000 mark.
How many times have you missed sending out a report?
So we missed sending out a report once, I guess. It was this Thanksgiving holiday, and so what we've learned is quality over quantity over the years. You don't need to publish so much. You just need to give good quality information to your subscribers. So the Thanksgiving week was a shortened week, and so we told our subscribers we were not sending a report over Thanksgiving. And it was the only time we missed it, even though we alerted our subscribers. And interestingly enough, we rarely get subscribers reaching out to us, which is a good thing. Means our presentation is clear, people don't have a lot of questions. And if in 12 years or 11 years of doing this, I had the first I guess complaint or subscribers calling our attention. Two of our subscribers says, hey, where was your information over the Thanksgiving holiday? So it was a relief, because it let us know people are really reading our information, but they don't have a lot of questions, so they're understanding it. And then whenever we don't publish it, people miss it, so it's good for us.
All right. So with regards to your presentation, you have a team. This isn't just you, right?
The presentation is not on the screen anymore, by the way.
No. I know that. I'm trying to talk to you. So look in the
Got it.
camera.
Got it.
So Brickell Analytics isn't just Isaac Gilinski. There's people behind it. There's people that helped you develop the quant models. There's people that help you to produce the wave theory on a weekly basis and assemble the reports. I'm very impressed by how consistent that you've been. Right. and I'm very impressed by how pure you've been with technical analysis. So, with regards to the team, what people don't realize is that you have a very, your team has been with you for almost a decade. How long has Federico been with you? Moise, how long have these guys been a part of your team?
Yeah, so as many as you know, many of you know, for the first part of in my 2 decade experience in the labor force, I for the first decade I was on the buy side and I managed the family office. And then I flipped to the sell side in 2010 2011 when I started the research service. And when I flipped to the sell side and started doing global macro research, I set up these two departments: the department of systematic research, and then the department of discretionary research. But both of them had to be technical, no fundamentals. And I hired two directors for both departments, and they've both been with me since we started the business,
Right.
which has been great because there's been no need for turnover and no need to hire more people, right? You just get the same people giving you running these two departments, and that allows me to run a very efficient operation with low overhead.
Right. So both of these guys are highly educated. Both of them have a ton of experience. Both of them have been trained inside of very, very large hedge fund environments. And the audience here is not fully able to grasp um, the detail that you go into on a weekly basis, um, because they haven't been told about it. But your quant model has exceptional results. Um, would you like to highlight about the quant model?
So that's a very interesting question. I'm glad you brought it up. Our quant model's up about 8% this year. So S&P is down whatever 15%, 17. I don't know what the exact number is right now, but we're up 8. So we outperformed the S&P about 25. We're outperforming the S&P up about 25%. I mean, the model was up 20% this year at the October lows. The signal, has been very slow at flipping to long. It's been short, most of 2022. But regardless, we've outperformed the market this year, which is a success because it's a very plain vanilla quant model. It's just a model that tells you where the S&P is going to go on a daily basis. You get a signal at the close every day, so you know what the model is thinking in regards to the S&P for the next day, but without driving you crazy, because this signal does not flip and search for it's not a day trading signal. It doesn't search for short-term trends. It searches for longer-term trends that last between 3 months to 6 months. I don't think I have the quant model on here. We took it out from the presentation, but um, we have a track record. It has an 11-year track record, and the signal is solid. So you may be looking at a short signal for 90 trading days every single day before you get a long signal, because it
So
just
it,
sits
it
there.
tells you it tells you to go long. It tells you to go short. Uh, and
But
it
yeah,
tells
but
you
you
to
don't have
sense
to.
the
But you don't have
signal.
to. You don't have to actively trade it. So let's say the signal can be short for 3 months. So you just short the S&P, and you literally have to do nothing for 3 months, other than monitor the signal for a potential change in the trend. But if it doesn't change, you're going to know what the model's thinking on a daily basis, but you don't have to do anything. And same thing happens with the long signal. The signal may go long, the model may spot a long-term trend, and it just stays long for 6 months or a year. You just don't have to do anything.
All right. Um, so now you got the weekly piece, and then the quant model comes out on a daily basis, 5 days a week. And it basically tells you either long, short. It tells you how strong the signal is. How does it
No,
how does it do that?
the model does not discriminate on the strength of the signal. It's just long or short, period. It's a quant model. and it doesn't discriminate. Discriminating is called this discretionary. It decides. It's just a solid signal. It doesn't know whether the trend is going to change or not unless the signal changes, right? Period. What does give you some level of clarity as to where we are in the cycle is an indicator that goes into our quant model, but we segregate and give to our clients also, which is our sentiment indicator. And that sentiment indicator has a table that goes from like extremely overbought to extremely oversold. And we know how oversold the market is or how overbought it is. And the more extremely oversold it is, the closer it is for a bottom. And the more extremely overbought it is, the closer it is for a top. And then we have a velocity indicator strictly on the S&P that does the same thing. So our sentiment indicators here work for all asset classes: bonds, Bitcoin, currencies, commodities, and equities. And then on top of that, we measure the speed of the S&P with what's called the Brickell speedometer. But both indicators, both velocity and sentiment, shoot a signal telling you whether the market is very high or very low, using contrarian analysis based on whether it's extremely overbought or extremely oversold. And then there's a range in between.
All right. So explain to me how you combine the speedometer, the Brickell speedometer, with the weekly sentiment analysis through wave theory that you produce. So you'll get some sort of signal,
So
and
what
then
happens is let's leave the quant model aside. It has its mind of its own, but we get sentiment, price, and velocity that goes into our global macro analysis. So price is what we do on a discretionary format, where we basically give you a price target, and we give you a wave count and a price target on where markets are going. But then we use our velocity indicator and our sentiment indicator to let us know whether it's a hard bottom or it's a soft bottom. So let's say we get down to 3,900 and the potential of the SM, we were at 48. We go down to 39, but velocity and sentiment are not on an extreme level. Then there's potential for markets to overshoot on the downside. But if these indicators are extreme and we went from 39 to 35, we may have a lot more conviction on our trade and be calling for a harder core directional move or change in trend.
all right. So that was basically what I was trying to get at with you, is how you use the different components of your work body to like have conviction and to enter into positions or stick with things as markets adapt and adjust to new information and price discovery. So I really like the way that you do that, and you integrate other pieces of your work to help you, like, say, all right, this is insightful here. I wouldn't look at this on its own, but this combined with the technicals on wave analysis, this is a good time to get in, or I should wait a little bit longer. So
Yeah,
Isaac,
which let me highlight that, which is
yeah,
so it's four different buckets: our time component, our velocity component, our price component, our sentiment component. Are all calculated differently, are all separate. They don't work. We don't need the sentiment to give us the price, and we don't need the velocity to give us the price, and we don't need the time to give us the sentiment. They all work separately, but we use them all to basically give us our conviction and our directional view on markets. And subscribers get to view them independently. So if you guys don't agree with us, you can make your own forecast on whether the S&P at 3,500 is a bottom or not, based on our sentiment indicators, because you are working together with us. You're going to get these sentiment indicators, which is the raw data, and then you're going to allow, and it helps you as an investor, as a trader, as an allocator, to use it in your work as well as an added value component. And then you either side with us or say, hey, the Brickell Analytics forecast is going to go against them about 5%, 10%. Eventually, it's going to rewrite, but not right yet. his sentiment indicators need to be more extremely oversold. So it allows you to make, discretionary decisions as well.
So Isaac, why are you so focused on technical analysis over all the different things you can use to forecast markets? What made you choose that to focus on?
Well, I mean, the bottom line is, after doing this for 22 years, my background was all fundamentals. I did, a bachelor's degree in finance, MBA in finance, worked on Wall Street, and brought all of that experience to start my own family office. And then in the end, fundamental analysis fails to capture the major turning points. And if you're wrong at major turning points, then all the work you've done for all these years gets thrown out the window, because you can be very long for a very long period of time thinking markets are going to go higher. And then you get caught in a 50% crash, and all your losses for the last 20 years get wiped out. So there's no turning point, there's no contrarian element to fundamental analysis. And that's the key. Once you can call a turning point, a trend change, and be contrarian, then the rest, will align itself. So you don't get that from fundamentals. You have to resort to technicals. And after doing this for so long, then you really begin to realize how, fundamental analysis is simply like a lagging indicator to technicals. It's just information that fits your storyline. So in the case of DocuSign, for example, like, we really like, DocuSign from a technical standpoint. So we're going to go in, we're going to do some financial statement analysis, some projections. We're going to look at the DocuSign investor IR presentation and try to develop a forecast for DocuSign at 177 based on fundamentals. But the truth is, this is a biased report that we're going to put together. Let's say DocuSign, the market cap of DocuSign right now is $10 billion. And we think it's going to go up by 3.5x, and so it should be valued at $45 billion. We'll do not a discounted cash flow model, but some sort of valuation using fundamental analysis that gives us $45 billion in value at DocuSign. But it's a biased report based on our technicals, right? So I think, the market fails to grasp that. Like, markets move on sentiment. They move on fear and greed. And then the fundamentals come and just fit the picture to help you explain the story or the price moves.
All right. So we've talked about Brickell Analytics. We've talked about your different research reports. We've talked about how you are a purist. We talked about your consistency. We've talked about a lot of things that people didn't know about you. You went into your background, how you got started at Lehman Brothers, and then you started to manage your own family office. And I don't think we touched on who some of your clients have been. Like, who are some of the most prominent people that you've advised in the investment world? And I want to start off with, Soros.
Yeah, I mean, I don't want to get into names for confidentiality purposes, but you take the Forbes 400 list, 400 richest Americans, and we've done business with at least 5% of them or 3% of them. So we've done business with wealthiest of Americans to the largest of institutions, to large hedge funds, to and now we want to take this, which is what we're doing with Flya, and we've been doing it for 4 years. We want to take it more retail and create more of a product that everybody can use, and make it easier to adapt, so that we have a bigger business than just advising a few hedge funds or a few billionaires and billionaire family offices. But we've done business with for at the top with everybody for 2 decades.
So, can you give us some ideas of the types of trades that these big institutions have put on through your market forecasts and your calls?
So one of our most noteworthy forecasts on the macro front, that's actually publicly traded or publicly verifiable, because we don't want to give any information that's not verifiable, is we recommended a short on the on the Aussie dollar in 2013 when it was above parity against the dollar. And we recommended that trade. And separately, I don't want to connect the dots, but there's a big family office that shorted the Aussie to the tune of $1 billion at the same time that we were putting on that trade. And then the Aussie dollar declined against the US dollar about 15%. So if you kind of do the numbers, our forecast coincided with $1 billion short trade on the Aussie, and then the Aussie went down 15%. So that individual made about $150 million. And so again, we were timely in the sense that we had the same view as this family office in the currency markets, and that all got kind of put together and acted upon, and it kind of worked. So I think that's what you were trying to ask me, right?
Yeah, I mean, I'm trying to ask you that, but I'm also trying to, highlight with you some of the like renowned investors that trust Brickell Analytics for information. And I'm trying to explain to the audience that, they're not the only ones tuning in to listen to you, that, the most iconic investors of our time have relied and trusted you for investment signals. And I think they should too, right?
Yeah,
That's
correct. And I think the point is that we don't want that market anymore. We want a more mainstream market and give the same information to everybody instead of working for a select few, because it allows us to build a much better business than just a business that's dependent upon working on renowned investors and on what side of the bed they wake up on. So one day they're happy, the other day, they're in a bad mood, and then it creates a lot of volatility in your business structure. So we would rather, as we would rather cut our prices down, which we've been doing over the last 4 years, cutting our prices down, 95, 97%. We've cut our prices down more than DocuSign has gone down, so that we can expand our research service to the mainstream, and to attract more people to our service, which creates, in the end of the day, a product that adds more value added to a lot more people than just a select few people that want to trade financial markets and make hundreds of millions of dollars.
Is this the trade with that iconic investor? Is this the one that like produced those massive profits?
Which one? I'm sorry.
The one that I'm sharing on the screen, is it 2013 Aussie
I
dollar?
can't. I can't see the screen.
I'm actually right now showing Brickell Analytics website.
Yeah.
And was this the 2013 trade?
I don't see anything, but I mean, I'm gonna gather that you're showing them that Aussie dollar or US dollar forecast where the Aussie was at 103.
Yep,
Is that
that's
the
the
one?
one. That's
And
the
we had
one.
like we had an 85-cent target.
Yeah, that's the one.
Yeah, that's the chart. So that chart that we shared with that investor is using the same person to create that chart, and it's the same chart we're sending out on a weekly basis to our subscribers for their investment purposes. And
So look, it's easy for people to discredit and say, "Oh yeah, you're showing us a chart and this and that, and yeah, sure, you want retail people to have this research. If you're dealing with the smartest investors in the world, why do you want to take it out to the masses?" So let's deal with that head on. And even though nobody's saying it, I promise you they're thinking it. Um, so I don't think people really understand, like, even though you helped this person get richer than they already are, um, did they didn't want to pay you extra for your service, did they?
no, no, they did not. And as we said, as I said a few minutes ago, the volatility of dealing with large clients, a select few, is not worth the reward. It's better to just try to push the product out to the most amount of people for a price that can cover your overhead and eventually make you profit than working for a few people, right? Because that's not a sustainable business. I mean, Amazon, the minute that Jeff Bezos went out and it changed his business model from a bookstore to an online bookstore to I'm going to sell everything to everybody. He developed a profitable business or a very large business. So businesses, are built on a product that works, that people can use, that serves a purpose, and at an affordable price, and that to everybody that can use it. So our objective has been, because we're now going into our, I think it's going to be our 50 19 20 20, it's going to be our fifth year of working with Fly on this. It's going to be our fifth year where we're pushing our product out now to the retail market for an affordable price, so that most people can use it, because it's a product that works, it's good, sources of information, and people want to know what's going to happen, what's happening in the financial market. Same reason people subscribe to the Wall Street Journal, or they subscribe to the Financial Times. There's many subscriptions out there, for an affordable price. Is the same thing we want to do. We have quality information that tells you where markets are going to go, and everybody should be able to use it. So that has been our business model, than working for a few billionaires, in how we originally started in our business. And so we're going into our fifth year of expanding into the retail network, or to on a smaller scale.
So, Isaac, do you use your own research?
Yeah, we use our own research all the time.
So, are you just a researcher, or are you also an investor?
Yeah, we trade. We try to create, asymmetrical trades with, high risks and high rewards, or, low investment for high upsides. More on on an option basis. We try to focus on market timing, because I think it adds quality to our report. So if we're telling you, hey, things are going to go up right now over the next 3 days, we want to trade options and bet on that.
So, I think I'm really good at finding inflection points, but I think that you're actually better. Um, so, as somebody who's good at something, being able to recognize that somebody's actually better at it than they are, um, I have really appreciated your insight into things that I thought would never turn. Um, as your son will tell you, because his bar mitzvah gift that I gave him is been devalued by about 80%. Um, sorry, Jacob, if you're listening. Um, you've seen crypto going down. Now you're calling for a reversal in crypto. Like,
Correct. So
how do
what
you
what
how do
we
you do that? How do
so
you
what
sit
what
there and call for a demise one day, and then next second you're
so
calling for a
no, it's not.
rally?
It's
Like,
please. It's not the next second. We were sitting here in your office during Thanksgiving 2021, and I said crypto is gonna. I was a little dramatic. I said it's gonna go to zero when it was at 68,000, and my forecast was right for 85%. It went from 68,000 to 15,000, whatever percent drop that is. So no, it's not a minute to minute change. It's a 12-month evaluation of our forecast. So we've been right for 1 year. The thing dropped to 15,000, and now we're thinking about it and saying, okay, maybe it's time to change. There's no need to call for the demise of crypto right now, because there may be a bullish wave. So one thing we've learned over the years, and I think this is what differentiates us from our competitors, is we're really not in the business of selling subscriptions or selling information so that we can call for the end of the world. Calling for the end of the world, one day the world will end, one day it won't. As Stevie Cohen once told me at a Goldman Sachs conference at Yankee Stadium in New York, I think it was 2013, 2012. He said, "Look, that's a very difficult trade to call for the end of the world." So, and he was right. Calling for the end of the world, being bearish, it may sell you subscriptions because you're selling fear. but it doesn't make people any money, right? So, we started in the business of selling fear, selling crashes, everything is going to go down. And we've gotten very flexible over the years, because being always negative doesn't make you money. What makes you money is calling for trend changes, directional changes, big turns. So if we're going to go up, you got to tell people markets are going to go up, and if we're going to go down, you got to tell people markets are going to go down. So again, to crypto, we said crypto was going to go to 3,000 or zero. Here in this same spot right now where I'm giving this presentation, and it went from 68,000 to 15. So it was a large drop, but 15, it's not zero. And now we like it. We think it's gonna go up. I mean, if we'd be more aggressive in our forecasting, we'd be presenting some of these crypto miners and telling you that if the price of crypto is gonna go up by 4 or 5 times, then these crypto miners, are gonna go up 20 times. But we haven't gotten there yet. So we just think, Bitcoin is going to go up maybe 2 times, maybe 4 times, maybe 5 times, but it's the right turning point to turn bullish on crypto. Why? Because we want to get the direction of the price right. We don't want to sell fear. And, we got the direction right. And that's as much as the market is going to give us. We've sat here for, 6 months in 2022, and Bitcoin does not break below 15,000. We've had major drama. One of the major exchanges collapsed. One of the biggest scams ever. And then instead of crypto going below 15,000, it's actually getting closer to 20,000. So that should be your sign. You get all the negative headlines that we were talking about a year later, and instead of crypto going down, Bitcoin going down, is actually going up, right? It doesn't break that 15,000 level. So from a wave standpoint, we think there's some bullish wave forming here in crypto. And it's going to take this thing, if it's correct, it's going to take this thing up to 70,000. It's the same count as the S&P. It was a wave 4 down, and we're going to have a wave 5 up. Now, it could prove to be a wave 2 up. We already started the bear market, and if it's a wave 2, it's going to go up to 50,000, 45,000, 60,000. It will recover some of the losses. So we have high conviction, or we feel confident that at this juncture in time, crypto is going much higher than lower. Now, if you get to 70,000, it would be great. I mean, we bought Bitcoin now for the first time ever at 15,000, and we're gonna experiment and see. We're curious, but we think it's gonna go up. I mean, if you want to be conservative, let's say we get our forecast right, then you take your profits at 40,000, 50,000, whatever. And if you want to be more aggressive, you let it ride. But this is that time in the cycle, and this is where this,
How come you didn't show the call on Bitcoin from last November?
You take the time model, the time model component of our analysis, and you say, hey, instead of selling fear, let's sell some a money making call, right? Let's go for a rally in Bitcoin, which could be counter trend, it could be fake, so that people can make money if we get a call, right? Like the same thing here on Coinbase, right? We're not calling for 1,000 on Coinbase, but if Coinbase bounces to 150, which is way below its IPO price of 450, you can still make 5 times your money. So I think that's the right call. We did not show subscribers historical forecasts, because you and I have been in business for a very long time, and it's kind of old already. People have seen our stuff time and time again. People know where our website is, and proven whether we've been right or wrong over the years is already, I think, something an obstacle that we have already overcome. And I think it's we don't want to come here and tell you, oh, we said this or we said that, because people know that. I mean, people know how negative I was on Bitcoin in 2021. We just want to tell you what's going to happen, over the next 6 months to a year.
I think people misunderstand you, though, Isaac. I think you're misunderstood, and I think that people, they need to see the other side of you, because they seen and they remember. Like, we got Bill Jacoby on today. Bill is a longtime friend of mine, and he was one of the executives that was part of the fund that had the Big Short, team in place. Bill, you got to get your new shop, Eagle Trading, to sign up for Brickell Analytics and integrate it into their process. I'm sure that you've seen and heard from Isaac many times over the years, but he has been bullish. He's been bearish. He's swung back and forth. He's not just a pessimistic guy who's constantly bearish on markets. He's been extremely thoughtful, and he's made bearish calls on things like oil and natural gas when I would have never thought the next $50 movement would be down. And he's nailed it multiple times over the last decade, and he's gotten it right. And I've been very impressed with his ability to, to separate the noise from the real signal. And then, Isaac, this brings up another point that I want to address with you. You mentioned drama, right? A little bit ago. Do you think that it might make sense to take drama out of your forecasts? And
Yeah,
instead of,
which is what the point of technical analysis is, right? Technical analysis is not an emotional way of forecast of doing business, right, or forecasting. You follow the waves and you do the forecasting. And I remember in the middle of the COVID crash, an internal discussion I had with Federico, our technician who does our charts. I said, Federico, we've been waiting for the collapse of the financial system for 7 years, 8 years. Markets are going to crash. They had already gone down 35%. All of our sentiment indicators, everything was as a screaming buy. And we were like, our Federico was like, look, we're going to go up. The S&P's at 2200 is going to zoom up to at least 3,400. It's going to recover the low, the high from COVID, which at that time, before the COVID crash, was 3,400. 3,390 was February 2020. We're going to go up to 3,400 from 2,200, no matter what, which at that point was like a 50% rally. And I said, how is that possible? It's the end of the world. We've been calling for it. Let's continue calling for lower prices. And he said, no, this is the wave down is complete. The sentiment is very bearish, and we're gonna go up. And we put a very bullish forecast. Mike, you remember this
I
because we
was
were
on the
here.
other side. I was wrong. You were right. You guys were right.
Yeah,
I
we
was
were
wrong.
here, and I didn't let I, as emotional as I was, or as much as I would prefer the short side over the long side, I followed our research process, and I came out and we put out a bullish forecast. And I mean, we have a client that is he owns 5% of one of the largest food and beverages companies out there, who's old money, and he's known us for a very long time. And he called us and he said, look, we're being advised by the economic advisors to very large countries. We sit on all these boards. We're seeing all these mass layoffs. I think the S&P is going to go to 1,000. It's the end. And I said, look, I appreciate you're very well connected. You're a very wealthy person. You've been around for a very long time, but we are not going to come out here and call for the end of the world just to sell more subscriptions. It's just not the right thing to do. As much as I like it, as much as it feeds off of the negativity, our technicals are calling for a market rally. The S&P is going to recover its losses, and the safe target on the S&P when it was at 2,200 in March of 2020 is at least 3,400. It's going to rally, at least 50%. And it went up a lot more. It went up an extra, 1,400 points before it gave it all back. So we've learned to take emotions out, biases out. The biases are the worst. I have to be always bearish, or I have to be always bullish. and we adapt to the waves. And the waves is a theory. It's not even a theory anymore because it's already been tested. It's a school of thought. It's a way of doing, business. And when the wave is up, you got to be bullish, and when the wave is down, you have to be bearish. It's as simple as that.
So we're inside your report. We're at an hour and 5 minutes in here. I want to go back to your bio. All right. So here's your bio, right?
Right.
The best businesses are created out of necessity. Can you tell us why you created Brickell Analytics?
Yeah, and the interesting thing is that necessity, you have to kind of like dissect it a little bit, because a lot of people build businesses out of their garages because they haven't. It's the rags to riches story, right? The rags to riches story is a story where you have to build a business, right? Because if not, you won't survive. In our case, it's we have to build a business, but not because we're not going to survive. We were the head of a very large family office, but we have to build a business because, as you said, it's the correct thing to do. It's the pure, from a purity standpoint, it's the right thing to do. Like, how is it possible that literally we went to one of the best elite private schools in the country, in the US? We went to one of the best, high colleges or universities. We worked at one of the best investment banks, even though it failed at that time. It was one of the best. Had a great MBA, had a huge family office, and the investment process is just wrong. Like, people are just, you're being taught fundamental analysis at school, in university, in Wall Street, and then you're investing on the premise of fundamental analysis, and none of that stuff works. It's all technicals. So the necessity of us to go out and share this information with the world is what allowed us to kind of like build a business, which I think that you, in your very, detailed micro analytical mind, you nailed it when you called us, purists and technicians. We did it out of the necessity of just creating the right information because we didn't have it. And out of that, we have seen, and we continue to see, a great opportunity. It's a great opportunity to go out and tell the world that markets function on technical analysis. They don't function on fundamentals. And it's a lot more exciting than running a family office, running money from families that have made money for a very long time. That's just not what we came to do. So that's why we created this business. So it's a business out of necessity to share the right information, but not as much necessity that we need to become, we need to get out of our rag story that we're in, our rag life, to become a Florida life. So it's kind of a different setup, but those are the hardest, because those are the hardest businesses to do, which is where you have money, but you still want to build the right business, because the motivation to do it is less, right? So, and building businesses is just very hard, especially in this day and age where people have everything and information is for free. So that's even the most difficult business of the world, is trying to create a valuable product out of something that's readily available and everybody can have, and everybody has an opinion on, and nobody wants to pay for it.
Well, I honestly think that you nailed it today. With the whole like concept of you were using this research to help manage family assets, and you still use this research to manage family assets. It's just you're taking something that you see valuable that others can use, and you're sharing it with them. And I think the greatest businesses are born out of that necessity. Like, you created something, you stay disciplined to it, you stay pure to your to your knitting, and you don't color outside the lines. And people may be looking for more drama, but you're not giving them a fundamental story, right? And that's what people can trust you for: trusted, contrarian research.
Yeah, the,
And
the drama right now, you can create it on on Bitcoin. You can point to many different ticking time bombs on Bitcoin right now. after the FTX failure. And we're going to do the opposite. We're going to say now it's time to buy when everybody's trying to look for drama, so that now the 3,000 target that we had back in 2021 can be justified, right? Because it's just take the technicals, they remove the drama, they just give you a price target, and you just got to trade those price targets. And over time, you get better at it, and they work.
All right, so we have to wrap things up now, Isaac. It's been great having you. I want to wish you and your family, happy holidays. I want to thank everybody for joining us today, and I hope you take what was said today, reflect on it, and come back in 2023, and you crush it from an investment and financial perspective. Thank you again for coming on and continuing with the tradition that we started and we've been sharing with people. Next year, we hope to have you back on, at least a couple, if not 4 or 5 times throughout the year. I get the feeling that it's going to be an exciting year in financial markets, and price action is going to be in the 2-3 standard deviation range. So I hope that you share some of these outsized trades, these asymmetrical trades that you put on with our group. I'm going to circulate a copy of the presentation with the people who signed up, registered, attended, and are requesting the presentation. So
Yes, if people need to get a hold of us, they can reach out to you, or they can email us at outreach@brickellanalytics.com. Outreach@brickellanalytics.com. We're going to circulate this information at free of cost. We have already circulated part 1 of the DocuSign report, where we're very bullish on DocuSign, and we're going to write a fundamental report on DocuSign valuing the company at $45 billion. And if, Mike, you don't mind, we can circulate that part 2 as well. And these, would be at free at cost. But as to summarize, we think, this is going to be a bullish rise before the bust. And, DocuSign is one of the best trading ideas we have right now. And again, if you want to reach out, please don't hesitate to email us at outreach@brickellanalytics.com.
All right, and I'm going to give you guys all a way to get in touch with Isaac directly. And, we appreciate you tuning in. We wish you a happy holiday, a safe and prosperous holiday. Anybody that's, has any questions, would like to be contacted, introduced to Isaac directly, please reach out to me. But I will be following up with a copy of today's recording, as well as the way to download the presentation. And if you'd like to be added to the Brickell Analytics commentary that he has from time to time, just please make a note of it for us. And thank you for your time and attention. We wish you the best holiday.
Thanks.